Hi there, this is Mike, and today we're going to look at capital gains on depreciable assets. So today we're going to use the example of an individual who owns a building and is renting it out to tenants. So the information that we have is that he is not incorporated, so all the rental income and the capital cost allowance, which is the Canada Revenue Agency term for depreciation, will be declared on the individual's personal income tax return. So this individual purchased a building for $452,000, earned rental income for 3 years of $20,000 per year, and disposed of the building for $517,000 at the end of year 3. So we have 3 challenges. One is to calculate the adjusted cost base. In other words, what did the building cost us? Calculate the capital gain at the sale of the building, and calculate any capital cost allowance recovery. So we'll get to each one of these in a step-by-step manner. So the 4 steps we're going to look at is first are calculating our adjusted cost base, otherwise known as ACB. We're going to calculate the capital cost allowance, otherwise known as depreciation. We're going to calculate the capital gain when the property was disposed, sold. And step 4 will be to calculate the recovery of the CCA and see how that's included in your taxable income. Here we have a table showing the purchase price of the building, some calculations for CCA, and some calculations relating to the disposal and the recovery of CCA. So let's take the first piece. What is the adjusted cost base of this property? We see here that this individual paid $430,000 for the building, $22,000 of transaction costs for a total of $452,000. Now we need to know, because we're going to be calculating some depreciation, we need to know what proportion of that is related to the building and what is related to the land that it sits on, because we don't depreciate land and don't take CCA on land. So what we've done here is we've got a calculation on the original purchase price, the original listing price of the building, which shows that we are calculating a pro rata of $300,000 on $430,000 for the value of the building. So that will give us 70% of the building price is related to, of the total price is related to the building, which gives us $315,000. If you see here, we've just repeated the 70% times the total price that we paid for it. To calculate the CCA, this is the Revenue Canada term, or the Canada Revenue Agency term for depreciation. And you'll see in this table we have some additions during the year, the $315,000 for the building. We have what we call UCC, undepreciated capital costs, to begin the year. And we're showing our CCA rate. Now, Revenue Canada, CRA charges, allows us to deduct CCA on very strict terms. It's always declining balance. It's always the half-year rule, where you take 50% of the depreciation in the year of acquisition. And it depends on the class of the asset. So a building acquired after 1987 is Class 1, which carries a CCA rate of 4%. So if we do the math, we've basically got our UCC, undepreciated capital cost, multiplied by our rate of 4%, and we've taken 50% of that, and that gives us $6,000. So like any declining balance method, we carry that 309 forward to the next year, and we've made no additions, so we calculate 4% for a full year, giving $12,000, and so on and so forth for the 3 years that we own the property. So in total, over 3 years, we've actually booked $30,000 of CCA. Now that CCA was deducted from our income in each of those years, reducing our tax owing, and we'll see that in a few seconds. Next thing we want to know is, what was the capital gain on disposal? So that's a fairly easy calculation. We know that we paid $452,000 for this property, and we've sold it for $550,000 less $33,000 of fees, presumably real estate agent fees, etc., for a net proceeds of $517,000. So that $517,000 less the $452,000 adjusted cost base gives us our capital gain, which is taxed at 50%. will include $32,000 of capital gains in our income, and that will be taxed at our marginal tax rate. For many students, calculating the CCA recovery is quite problematic, but it's actually quite a simple concept once you grasp it. So let's walk through what this individual's income tax return would look like if he had declared his rental income on his personal income tax return, because in this case he's not incorporated when we're talking about a personal income tax return. So in year one, assuming he had employment elsewhere, he would have, let's say, had $50,000 of employment income, $20,000 of rental income from his tenants, and he would have deducted $6,300 of CCA as per the table we just calculated. That would give taxable income of $63,000 at a tax rate, let's assume 26%. He would have owed $16,560. Just for illustration, without the benefit of that CCA deduction, he would have had the same $50,000 of employment income, $20,000 of rental income from his tenants, giving a taxable income of $70,000, which would have given him a tax burden or tax owing of $18,000. So the CCA, in effect, is a deduction from business income, and it has the impact of reducing your tax in the years that you're exploiting the depreciable property. Now, for every year that you reduce your tax owing using CCA, if and when you sell or dispose of the property and make a capital gain, the Canada Revenue Agency expects you to include the CCA you deducted during the time you owned the property into your income. Basically, they want to tax you on the deductions that you took over the years. So coming back to our table, you can see what I've indicated here is the calculation of the CCA recapture. Since we sold the building at a capital gain, we have $315,000 was our original UCC, and we have a UCC at the end of 3 years of $284,000. So we've actually booked $30,000 of CCA. In the year of disposal, that $30,000 would be included in income. On that calculation, if we were to take year one, we recall our purchase price for the building was $315,000, and we depreciate it. Its UCC, or carrying cost, or net book value, would decline over time. $315,000 is the original purchase cost, or undepreciated capital cost, adjusted cost base, they're all the same, and that was $315,000. So the differential between the price you sold it at and the price you bought it at is your capital gain, and it's taxed at 50%. The CCA recovery is added into your business income, and it's taxed at your full marginal tax rate. So hopefully this is explained in a bit more detail, the calculations surrounding capital cost allowance and capital gains on depreciable property.